So I think we'll just kick off by introducing my esteemed panel here, who have all got some great things to say, I'm sure. So, Banesh, do you want to kick us off? I think it should be on.
Hi, can you hear me? Yeah. So, my name is Banesh Prabhu. I'm the CEO of Intellect AI. I have a presentation immediately after this, so we'll spend more time on Intellect AI. Spent most of my time with Citigroup, used to run their technology and operations for several, was more than 2 decades with them. The last 10 years I've been doing various kind of different technology implementations, a lot of them with Intellect AI. So that's a bit of a background from my side.
Excellent. Tamara, do you want to?
Good morning from my side as well. My name is Tamara Kostova. I'm the founder and CEO of a WealthTech company called Velexa, a B2B investing platform as a service, a shop. I'm a latecomer into the fintech startup space, I have to say. So I spent more than 2 decades into the capital market space with the likes of UBS and Deutsche Bank. So I was very much passionate about kind of really focusing on embedded investing and how can we drive financial inclusion. So I'll be very happy to share some of my insights on this panel. Thank you.
Excellent. Great to have you here tomorrow. I think Charles, do you want to introduce? Oh, sorry, Arnaud. We'll go along in sequential order.
Fantastic, thank you. So, Charles Mullender, most recently I worked at Fidelity. I left in September. Have a long history, initially on the sell side and then transitioning across into wealth and asset management. I think I started my career building e-commerce systems back in the late 80s. So I've been around the city for a long time. Very interested in this particular space and hence the focus on this panel.
And last but by no means least, Arnaud.
Good morning. Good morning all. So Arnaud Denis, CEO of MediRect. MediRect is a private equity-backed pan-European digital challenger owned by Anacap Financial Partners. We have 3 lines of business, an asset liability model powering lending business and in particular mortgage. We have a WealthTech B2C platform operating in 3 countries for the moment, Netherlands, Belgium and Malta, with around 4.5 billion of financial assets managed through our app and desktop solutions. And thirdly, we have a nascent B2B software as a service business or wealth as a service business in the embedded wealth space. We are regulated by the ECB as a bank, as a systemic bank with over 400 staff, and most of them, and in particular technology and operations and back office, are in Malta.
Excellent. So we've got 4 or 5 key questions that we'll work through here as a panel. It should take us about 30 minutes to crack through those, and then we've got 10 minutes of questions at the end. But if you feel very strongly about something as we're discussing, please put your hands up and we'll take questions as we go. We're very happy to do that as a panel. So I'm going to kick off with one question. It's pretty broad, but I think, Arnaud, you're going to kick us off with a response here. But what challenges are top of mind for 2024, and what operational changes do you think we need to execute to overcome them?
So thank you for giving me the opportunity to open the panel. I'll answer 2 ways. So first, competitive challenges, and then let's say structural trends that impact all the ecosystem. Obviously, the wealth tech ecosystem is very broad, diverse. You have a lot of local players, a few global players, huge market opportunity, number of pain points, from consumers that are unaddressed. So this is a space where you can have a lot of new entrants and a lot of change in the industry. And if I try to summarize, the digital wealth tech platform on the B2C side, they're mostly trying to figure out how to scale profitably and in particular lower the cost of acquisition, which is one of the key elements. The incumbent players, the neobanks and the largest fintechs are rather focusing on expanding into the wealth space to monetize their client base. And there the issue is largely how to operate at the pan-European level and navigate cross-border complexities, because in the wealth space in particular it's quite difficult. You have the B2B players, the wealth tech B2B players like Velexa and others that are basically focusing on promoting easy to integrate turnkey kind of embedded wealth solutions to FI and non-FIs. We have a survey that suggests that in Europe you have over 300 tier 2 and tier 3 banks, only banks, with no or limited digital wealth capabilities. So that gives you an extent of the massive market opportunity. And then, of course, the larger technology solution providers have a wider set of solutions and are offering maybe more tailored solutions to larger FIs. Then, conversely, the incumbent banks are catching up, and improving their setup in terms of wealth capabilities, and sometimes trying to harmonize the setup across multiple countries, sometimes trying to pick, certain part of the value chain where they are weak. And for them, the issue is mostly to retain their client base, because their client base constitutes the fishing pond for everybody else, basically. And then you have the asset managers that are looking to build distribution partnership with digital platforms, or possibly build their own D2C channel. So it's an amazing ecosystem with a lot of moving parts, but we are all facing the same structural changes that really constitute a new paradigm for the industry. First is, obviously, everybody talks about it, the emergence of AI that is impacting both internal models and the product innovation, and around product innovation. Here the issue is how to adopt the technology, how to deploy the technology, how to build use case, and then how to embed this as a change management process, right, within a given organization. Because it's not a given that you have all the staff embracing this necessarily, so you need to create the conditions for change. That's the first trend. Second trend, around the need to address new consumer behaviors, obviously. We see them as a quest for more simplicity, better access, and obviously education. And I'll just stress the access part. We feel that there is a kind of app fatigue, sentiment among consumers when they have to log across multiple apps, whether they say standard bank, a new neobank to have good transactional capabilities, and then a trading platform. So we believe that one of the keys to unlock the potential and the mass adoption is to embed within the daily banking ecosystem wealth capabilities. So that's the second challenge around consumer behaviors. Obviously, environment. Probably we're at the peak of the volatility ever from a market standpoint, higher rates, high inflation, weak stock markets. Clients are chasing, are looking for yield. They're looking for savings product that they had forgotten about for years. They're looking for fixed income solutions. They're potentially interested by alternative asset classes. This means that the providers of solutions have to adapt, have to be flexible in adjusting their product scope. And in the same manner, regulation is extremely volatile as well. And in particular at the European level, it's not impacting the UK, but we have a big change coming in terms of ban of inducement, which means that we'll need to adjust some of our models with more service fee model probably. So that's really something to cope with, this environment. And then what does it mean in terms of self-sustainability of the models, right? Players have to show that they can actually grow and make money. I was hinting to this just a moment ago. If you're a D2C platform, below 3, 4, 5 billion of asset under custody, it's hard to make money. And to get there, given the acquisition cost that you have to acquire retail clients, it's not a home run, absolutely not. And so one of the ways as well for those that have the capability to do this or the license to do this is to go and explore more capital intensive businesses and lending. So you have players that are looking to complement their scope of products so that they have different engines for profitability. And this is true in the neobank space, but as well in the wealth space. And last but not least, in terms of structural trends and challenges, the war for talent, the war for tech talent in particular, that will enable organizations to speed up change and embrace new technologies. And this is not just about salary, it's about much more than this. So Gen AI, new consumer trends, environment, self-sustainability, and I would say war for talent.
Very, very good answer. Thank you, Arnaud. Just picking up on one of the points you've made there, do you see there's going to be more sort of forward integration and consolidation across the industry then, rather than kind of vertical integration? At the moment, there's been a lot of consolidation of advisory firms or self-directed platforms, but you think there's going to be more kind of cross-integration to build out different income streams for a wealth manager?
Certainly, because with technology, whatever your let's say your positioning, you can basically aggregate different types of products, right? So
Yep.
there are more ways to make money out of a single platform,
Yep.
right? Through partnerships in particular.
Perfect. Thank you very much. Tamara, do you have anything to build on that answer from Arnaud?
Very difficult, I have to say. So Arno covered many things. Maybe just to summarize from my perspective as well, I see actually two trends clearly emerging. One of them is very much around financial inclusion. And for some of us coming from the space and being here for the last 20 years, every single time when we talk about democratization of wealth management, I actually face lots of cynical responses, but the reality is that we are going to see way much more progress being done within the financial inclusion in trying to get more unserved consumers into the wealth management journey. I have to share with you that over the last 12 months, I have seen an amazing progress being done into that space, even by some of the big ones. So I wanted to give you a couple of examples, like one of the main initiatives Morgan Stanley did last year across the board was to introduce fractional equities trading throughout the entire business units, so including the asset management, self-directed investing, brokerage business as well. So that was one basically major advancement for them in terms of attracting more mass affluent, mass retail to the market. Merrill Lynch was looking at basically bringing more AI and automation in terms of unserved customers being able to allocate the right advisor for them. So they built basically a tool that each one of us can use to understand based on our appetite and etc., which is the right advisor for us in a specific region and etc. I wanted to share with you also another example, like what Coutts did. Most probably you all have seen, I think they were very innovative in launching their new platform, like 440, I think it's called, that is actually building a community of their users so they're able to exchange ideas and etc. So I think that financial inclusion is something that we're still going to see, and that actually drives what Arno was saying, that B2B players trying to build these super apps and offer various type of services. Those are the first thing. And the second one, most probably, it's again the new customer demand for way much more personalized, contextualized services. This is where we are talking a lot about AI. I have to share with you is that the next generation of investor wants a very different level of service, and it's not only digital service, it's very much a personalized experience based on their risk appetite, based on their ideas of directed investing and etc. So I think that these are the two key trends that are going to change the way how we are even driving the technology innovation within the wealth tech space.
So to summarize that, you see the opportunity of AI to drive a really personalized service for the mass affluent at an affordable cost. Rather, I think most people see it as a means of just driving cost out, but you see it as a way of personalizing and creating a better service.
I have a very strong view about that. I wanted to give you a statistic. So 90% of Europeans and Brits, I would say that, would like actually to actively manage their finances. They want to invest, but the reality is all of them lack financial education. Most of us, none of us actually study finance at school, etc. So if you actually do a survey with your customers, investors and consumers, you realize that mass affluent feel very uncomfortable to basically actively manage their finances. So the idea of embedding AI is very much to guide them through the journey, making this service personalized so they don't feel intimidated. And when Arno was saying that a lot of the incumbents are indeed talking to us to implement investing services into their existing portfolios. But you know what happens? The adoption rate of these services within their existing consumer base is very low because people simply, you cannot go and, I'll give an example with my father. So his bank went to him and said, sir, you can now invest into these mutual funds. My father said, what? So, and he asked them, but my daughter told me there was a Bitcoin boom. This was a long time ago. So he said, can I invest in Bitcoin? They were completely lost. So I wanted to share with you is that the consumer needs to be guided, the investor needs to be guided, and that's why we want to see more of this personalization.
Perfect. Okay, very good. Anybody else got anything to add, or should we move on to the next question, Charles?
No, I guess part of that question talked a little bit about the operational changes, and the only addition I'd make to that is we're probably facing the the highest level of change I've seen in this space for many years. And yeah, I think one of the priorities has to be, how do you go about actually managing and implementing that change? So how do you evolve yourself to, from being an organization that perhaps used to run 2 or 3 big programs to an organization that's agile, that's able to move and adapt very quickly, that's able to seize opportunities within the marketplace, because that is the way we're going. And I think a lot of organizations struggle with it, and a lot of organizations are struggling to work out what's the right model, particularly if you've got a legacy technology backbone. Is how do I take that, embed it with some of the fintechs, with some of the new technology, and create this really agile culture that then drives your transformation. So.
Completely agree. I think I was here last year actually, and we were talking about this very subject. For me, the subject of digital transformation isn't about the tech. It's actually about the way that you go about executing change. That's the true power of the digital transformation, is reducing the cost of executing change and getting a better return on investment. But that's all about culture and the way you go about doing these things. And I think we're only at the tip of the iceberg at the moment in most big legacy incumbent organizations. Yeah. Very good. Let's move on to the next question then. So I think we can probably build on some of the points that have already been made, really. How are evolving customer needs driving industry change? Tamara, I think you're going to kick us off with this.
I touched a lot on that topic in the first question, but wanted to give you kind of again some stats that were helping us to basically refine our wealth tech innovation and roadmap. So what actually we see is that there is this new generation of investors emerging. Most probably they are not the most profitable one for the existing players, but they are emerging and they are quite active in that space. And what is interesting to see, and I'm sure that Arno has these statistics as well, but 70% of those investors, like the next gen investors, most probably Gen Zs and etc., are consuming investing services through non-traditional players. So basically they're not loyal to the existing players. They're going to go to a fintech type of organizations that very much align to their demand of services. So therefore, I actually see the trend of embedded investing or embedded wealth emerging. So how can the traditional incumbents partner with some of these fintech, wealth tech type of providers to build that journey? So we talk a lot about embedded finance, and it's all about payments, and most probably embedded insurance, but we speak very little about embedded investing, and I guess the regulator doesn't like it so much, so we should not forget about that. But how do we build that journey so we kind of stay relevant for that next generation investor base?
Really interesting. Banesh, we've not heard from you yet. I think you've got some thoughts around different customer segments and different needs.
Yeah, absolutely. So I think from a macro perspective, we definitely are seeing increasing wealth in pretty much many parts around the world. And in some markets, there's a transfer of wealth taking place between certain generations. And the numbers are quite large. I think we also realize that most of the wealth investment requires a combination of an advisor along with much better embedded technologies to be able to actually help the advice become more efficient. I think we've reached the point where change is easy to adopt today than ever before. And we're seeing the pace of that change quite significantly. I think the pandemic helped a lot of the digital guys who are on the sidelines move fast. I think we're well into what I would call the intelligence age in a way that is now on a hype cycle around AI. But I think the ability to embed AI into our day-to-day lives, whether it's to grow up our revenues or it is to become more cost-effective, less operations friction in our operating model. I think that whole combination of getting AI in different parts that can actually help the advisor become more efficient is one leg of it. But then the other leg is the various segments, as we spoke about. So you have, like we heard the other, panel members talk about, I think the mass affluent side requires a very much simple, non-friction, systematic investment plan type of a model of operating, which is sometimes not available with the existing players. Some of us who've been here for a long time know that we've sort of created the legacies in a way. The architecture has changed significantly. So how do you tap the mass affluent to, go into specific goals for wealth more easily than before? And then you go up the segments of high net worth and ultra high net worth, where the nature of the products, the interfaces between the advisor and what the customers do from a transactionary perspective and an advisory perspective needs appropriately embedded technology in there. And I believe embedded AI, as we will probably hear through the day, is going to be important. I think the journey is sort of beginning and it's being rapidly deployed. Clearly, wealth has a lot of compliance, there's a lot of security and privacy and other issues, and therefore managing that, and seeing who has access to what information, because it's all at the heart of it, how you use the data models and how do you tap the data models to easily help the advisor get more efficient. Most people trust their advisor, but at the same time, they say the advisor is not up the curve. And guess what? For the wealth that's being circulated, the number of advisors also are not enough. They're just not enough people. We see most of the institutions we deal with struggle with the number of advisors. So how do you actually help, develop and train those advisors at the right time to offer the right product piece, right? And I think all the way up to the private bank side.
Yeah, absolutely. It feels like it's genuinely the age where you could create the robo-advisor, and by that I don't mean an automated piece of advice. I mean a human that has all the artificial intelligent capabilities around them, so they become incredibly efficient, and you're combining that human digital capability to become incredibly efficient.
I think the robo-advisors have been around for some time in different shapes. Yeah. I think the high net worth or ultra high net worth and private bank requires a lot more a combination of technology and personal touch coming together. And I think the robo-advisor, in a way, today, with all the new technologies and the new language models, et cetera, from a technology perspective, can actually become far more efficient. And I think that's how you sort of, embed this intelligence so that the advisor is a lot smarter than he is. And I think there are a lot of use cases there that can be rapidly deployed. The problem is, as we've heard, there are different architectures around, and how do you actually consume those architectures within the business to be able to operate this? I think that's an important part. Yeah.
I know. I think you've got some views on embedded finance here.
I think the key point to really tailor the embedded finance solutions to your customer is understanding two things. First, obviously, your partner's capabilities, right? Where are they starting from? Are they licensed, non-licensed? And as Tamara was saying, you have a lot of non-licensed institutions that want embedded finance. I think in the UK you have a very nice partnership, and I'm just giving names out there, between Nutmeg and John Taylor, for instance. That's John Lewis. Yeah, that's an example of a really white labeling solution. So you have to understand where the partner starts from. You have to understand if they are already partly in the investment space. What are their capabilities? Do they have connection on the back end, and so on and so forth. Globally, their technology platform, are they good at integration? Are they good at authentication? That kind of fundamental questions. And then I would say, as importantly and even more importantly, what are the business objectives behind embedding the wealth solution in their ecosystem? Is it more tailored towards customer acquisition? Is it more monetization? Is it simply expanding the product scope to have something more on their platform? Or is it, having something that will achieve very fast go-to-market with a very simple solution? So different types of needs, and this will determine, as a B2B provider, do you go wealth as a service or software as a service, right? And which products are you going to propose to your partner? I give an example. If the partner is mostly looking to cross-sell its client base and monetize the client base, here, no need to push a broker solution. Go and push model portfolios and discretionary management solutions. To the contrary, if it's more around client acquisition and with Gen Z clients, then maybe you're going to push brokers. So a deep understanding of this and the use case and the business case behind is key, because ultimately this is how you will win the decision from the C-level at your partners on the partner side. And then you can add to this more value-added services depending on the partner's needs, possibly leveraging on AI and create some more interesting, capabilities in terms of reporting automation, in terms of rebalancing proposals and so on, personalized, as we said just before.
Very good.
And Paul, maybe I would like to add something as well. It's surprising actually to outline is that Southeast Asia by far is the leader in embedded finance initiatives. So it's amazing to see what they have achieved, and most probably you have an example in almost every country, like starting with Thailand, Indonesia. But what we see there, and this is ultimately where our main customer base is, what we see there is an amazing partnership between to give you an example, most probably you have heard about the Klein initiative, where a messaging app like WhatsApp Line partners with one of the biggest retail banks in Thailand to be ultimately payment type solutions through that messaging app. And then they started expanding the services, as Arnaud was saying. They started adding roundups, and they started with the US cash sweeps. They said, okay, you can buy your fractional ETFs. And it was interesting because the messaging app had around 6 million customers, to my knowledge. Within the first 6 months, they managed to get around 20% starting to use this service. The same thing is happening, for example, in Indonesia, where we are seeing is that I think it was HSBC partnering with a local retailer to offer specific type of financial investing services to communities in Indonesia. Unfortunately for us, we are kind of lagging behind, most probably because we are quite conservative, all of us. I think that Europeans are expecting to receive these services from their traditional players, so they don't change easily. So I would like actually to see more of those initiatives here in the region. Yeah.
Very good. Charles, anything to add? Should we move on to the next? Okay, let's move on to the next question. So we've heard a lot about investment, making sure that your investment in your platform, your technology has multiple use cases to get better return on investment. The power of AI so far, and personalization, and different kind of business models. That's a lot of tech that we're talking about. And how do you think wealth management firms ensure seamless integration and interoperability amongst multiple systems? They're all faced with legacy systems, new technology. How do you get that all to work seamlessly for customers? Banesh, I think you're going to kick us off.
Okay, it's an interesting question, because I think different countries, like what Tamara is saying, at different levels of evolution, and some of them have huge scale. I think the ability to get your architecture right has been going on for a long time. I think more could have happened with wealth. I think the cost of doing some of this has been significantly higher than it needs to be. I think the model of getting wealth into a much stronger subscription pricing structure than the traditional models is definitely around already. I think the core architecture, if it's not microservices and API driven, it can never really drive the headless consumption of new capabilities on one leg. So you just need the headless architecture to consume different capabilities for wealth, whether it's on the advisor side, whether it's on the compliance side, or any other side. That's one leg of it. The other leg of it is that we've already reached a point where the headless architecture and consuming specific user journeys without AI will probably be at a disadvantage today compared to where you need to go. So I think the ability to get your architecture for every institution is one leg of it, with the intelligence embedded, as I said.
Just for everybody, because I don't know the answer to this. So what do you mean by headless architecture?
Headless architecture is the ability for me to take my existing user journeys end to end. It could be any user journeys, could be something as simple as an onboarding, and actually take it through the whole cycle by putting together the ability to actually put the flow in a way with low-code technologies. I think a lot of the technology is already moved into that architecture and from providers, many providers. There's plenty of them. I think the ability to be able to actually wire that end-to-end journeys, everything in a business can be a user journey end-to-end. Yeah. And I think the ability to have the technology to wire that all together easily, and also consume different fintechs and capabilities in a marketplace sense, I think is a very important way of getting into the wealth ecosystem that is appearing, so that you can tap the right combination of checks and balances. That's one leg of it. The other leg of it is a greater focus on data. Many people have been using data warehouses forever, but the ability to take the right data mix and actually put it together in a way in which it can actually drive the intelligence coming out of it for AI is sort of vital. So you've got to go down the pathway to address both of this. You know, the large language models and many other technologies will help you do certain things, but the core quality of that data and where the data comes from, because there's a mix of your own data and there's a mix of external data. And then you have in other institutions and other capabilities, things like open banking and all, where you have the customer giving you consent to do things in such a way that you could actually put the whole information of a customer together. And therefore, the advisor has a much better view of the wallet of the customer to be able to give them the right mix of advice and the right balancing of the portfolio, across countries, regions, wherever, and depending on the type of customer. So I think that whole technology model of user journeys is what the headless architecture will provide you.
Does that need a much stronger voice around the C-suite from the CTO, basically? Because my experience of operating in wealth management over the last few years is it's not had a stronger voice, because I don't think these businesses have seen themselves as tech businesses.
Yeah, I think that's a good point, and I think there's a lot of educational change. Like, some of the folks say we moved from the industrial age to the digital age to the intelligence age, but we still go back to work in the industrial age. Yeah. So I think there's a lot of skill development required across the board. I mean, out of the 6,000 odd people we have in Intellect today, we've had to scale up many of the developers out from development into data sciences. There are almost 1,000 plus of those already, because your skill base has to be relevant going forth to what is appearing now. So I think the CTO also, has to make that change. Yeah. And I think, to be fair, the CTO normally tends to do things across the different platforms that they deal with, and many of them have multiple product lines and businesses and so on. I think getting that strategy and clarity and then actually doing this, today you can do it faster than before. I'm a strong believer in the progressive modernization. You have to build edge systems, take some of the data and the AI capabilities as edge solutions, but progressively modernize your road eventually.
Charles, you've had quite a bit of experience working with a large incumbent. Anything to add on this subject?
No, I like your point there in terms of the CTO and the importance of that. This is a tech-enabled business. If you said to me, name one thing that you want to get right, it's data. Data is the thing that drives a lot of what we're talking about, and your ability to then build services or leverage partnerships or things like that all hang off that ability to have a really solid foundation. I think part of the challenge is firms really struggle to understand what are the core key components that make up that foundation. And so spending the time and effort to actually understand that. And I used to use the analogy of saying, if you've got a fleet of petrol cars and you're moving to electric, work out what those core changes are, because there's only a few. The wheels are still the same, the side mirrors are the same, the seats are the same. There are lots of things you don't need to spend money on to make that change. But if you don't get the chassis, you don't get the batteries, you don't get the electric motor, you've got a problem. You'll never have an efficient electric car. So spending the time to focus on what those core components are, and if data is not one of them, I'm guessing you've missed a trick.
Yeah, completely agree. And while we're on the subject of sort of investment and cost, how do you think firms can strike a balance between driving innovation and effectively managing costs? Because most businesses are under some form of cost pressure at the moment.
I think it's an amazing question, because ultimately, your CFOs can have a view on the affordability of what you can invest. But for the last 20 years, I think we've worked on the basis. I can remember going back 20 years looking at project lists, and these are the cost-saving initiatives, and these are the business revenue initiatives, and here's some innovation things that we're trying. And I think that's past, right? I mean, if I think about a real example, I became head of robotics right at the beginning of robotics, and within 24 hours I had a single objective to cut 500 FTEs within 18 months. Now that's a very cost-focused objective, and you've just lost a massive opportunity in terms of what you can do for your customers or how you could use it to grow, or thinking more holistically about it. So I think the answer to the question is the two things are not different things. You need to combine and think of them in the same way. This is not a question of innovate or cost cut. It's actually you need to use innovation to cut some of your costs, and you need to think holistically about what that portfolio of changes that you have and how you invest your money. And I think what you'll find is, and certainly that's been my experience, is where we spent the effort looking at it, we could adopt quite innovative solutions which create some of those foundational blocks, but also take significant cost out of the organization.
Thank you very much. Moving on to the kind of last question before we start to take some questions from the audience. What do you think are the challenges in attracting the right talent, particularly tech talent, into the business while maintaining a company culture? Arno, over to you, I think.
Thank you. War for tech talent. Yes, this is something that we have to manage, I would say, every day. So there are three things that I'd like to underline. So first, you need to create the perception that your company is advanced in terms of technology, right? So it's about PR, branding, because this is the basis of the funnel for recruitment. If you're not perceived as a tech company, it's going to be very hard for you to recruit, skilled talents, right? And so that's a long-term effort, obviously. Luckily, if you have cutting-edge technology, it's easier. But in any ways, you need to be out there in the tech community, active, with your own tech blogs, possibly if you can. And this is what we're doing at MeDirect, contributing a lot to open source community, doing peer reviews so that you are perceived as a real techie player. You complete this with partnerships with universities, with running hackathons. I mean, a number of things to start to position yourself as a tech brand. And for us as a bank, it's extremely important because we want to be perceived both as a bank and a tech company. So we spent a lot of money there. And our history is a bit specific because we built our technology platform for the last 4 or 5 years by recruiting over 50% of our engineers from the iGaming industry in Malta, which gives us I would say different profile compared to other players. So first, build your reputation, your branding in the tech community. Second, run a very tight recruitment funnel. We receive at our modest level, every month around 100 to 150 CVs, and in the end, we hire less than 5% of this, 3% in fact. So we have a very selective process, to filter down through the recruitment funnel the talents that we really need. We have technical interviews, we have development tests, they have to code, we test the code, we put it in production, we see if it works, we have peer reviews. And in the end, we want to make sure we have the talents we need with the profile we need, because it's a virtuous circle. You start to get those, and then they're going to network and get the others, right? So recruitment funnel is key. And then the third point is, of course, retention. This is not just about salaries, although I was just looking at an ad yesterday that, some AI-driven fintech were recruiting software developers between 250K to 450K. That's interesting. But this is what you see in the market today. I mean, this is public stuff.
I'm going to retry.
Yeah, maybe. So the market is going all over the place. But I think that for true retention, you need something else than this. And the way we try to do it is that we give the space to our tech talents for creation and innovation, right? They want to be guided, they want to work in a very structured environment, but at the same time, they want to have the ability to continue innovating and thinking about new technologies. And the way we do it is that we embed in our, in our sprints at the squad level some capped development time to try out new things with specific objectives. And then when something nice emerges in terms of proof of concept, we put it on a betting board, and then eventually we can include it in the value stream mapping. So keep that space for innovation.
Yeah, completely agree. Certainly my experience of working with tech talent is, if you get 3 ingredients in place, you've got a chance of keeping them, and that's one, that you've got a mission that they kind of buy into, that they feel like they're doing something kind of basically cool and interesting. Secondly, that you give them empowerment. You don't smother them with bureaucracy. If they're not free to kind of get on and do what they would need to do, then they'll soon leave you. And thirdly, the fact that they've got the opportunity to develop and continue growing their skill sets. If you get those 3 things in place, then you've got a chance of keeping them. But if you don't, you're constantly in this kind of battle of retention and recruitment. Charles, anything to add?
Yeah, so I love Arno's story, and I think a couple of things I'd add is, the first of which is, we've typically tended to hire from within our own industry. Again, you've moved into the gaming space, but I think again about something like data. There are lots of industries that have been using data far more effectively than financial services for a very long time. So I still believe that bringing diverse talent in from different industries, from different perspectives, super important. And then the second thing is I know this is largely about tech talent, but actually, for this to work, particularly innovation to work, you need more than just tech talent. You need people who can challenge operating models. You need people who can turn around and have a conversation with a client and understand what the client really wants. So I think you need to think holistically about that. And leverage all of those component pieces, because those, for want of a better word, cross-functional teams that have the outside-in experience, that are able to leverage the best parts of other industries, are the ones I think that are going to really excel within the space.
Okay, well, I think that's us done with the kind of the formal kind of Q&A. See if there's any questions out in the audience for the panel. No questions? In which case, I think we can bring the session to a close. Thank you for your time.